Hey everyone, good to be here today. My name is Brent Moore. It's time for managing an options portfolio. We take a look at options trades and managing an options portfolio each week at this time. Glad you've joined me today. And familiar names in the chat. And if you're watching on a recording, that's great too. Glad to have you. Hey, I'm joined alongside Connie Hill, who's helping me out. I appreciate Connie. She's a wonderful instructor, and please make sure you follow her on X. Both of us on X. My X handle is @BrentMooreCS. Connie's is @ConnieHillCS. We both post additional content throughout the week on X. There you go. We're going to talk about earnings today and implied volatility. And of course, we're going to manage a variety of options trades today as we go through this. But before we get into that, let me just mention a few things. One, options do carry a high level of risk and are not suitable for all investors. Multiple leg option strategies involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of in-the-money amount. Rolling strategies can entail additional costs, including additional transaction costs, multiple contract fees, and the like. The material today is intended for educational and informational purposes only. And the paper money application will not assign short option positions early. That is different than your real trading account. And for the sake of simplicity, the examples in this presentation do not take into account commissions. All investing involves risk, including loss of principal. Schwab does not recommend the use of technical analysis. The sole means of investment research and past performance is no guarantee of future results. Hey, glad you are all here. I'm going to flip on over to the Thinkorswim platform. Hey, we have earnings coming out this week, and so you can see earnings if you're interested. You can go to the Market Watch tab, go to Calendar. And here we go. Today's the 14th, so I can scroll down. I just have it on list view, but you can go to month view or week view, whatever you want. But here's the list. There's a lot of stocks that have earnings. If you want to narrow that down, just go to the little gear up here, click on that, and you can choose a watch list. You can narrow this down to the S&P 500 if you want. That's going to narrow it down significantly. The S&P 100, I do that quite frequently. But let me mention this as well. You can also narrow it down to the watch list of your choice. So for example, if you go to a personal watch list and you've created a watch list and you want to look for earnings on that watch list, I have one that's, I don't know, Bull Flag RSI or whatever. You click on that and you see the earnings calendar for that. Or for example, I have one that is just called liquid stocks. It's going to show me just the stocks that are on that watch list that are on the earnings calendar here and the days they come out. So that's narrowed it down quite a bit, right? Here's today. We have Bank of America, Wells Fargo. Next Monday, we have Netflix, then Halliburton, and so on. Okay. So just be aware of that if you want to narrow it down to what you particularly want on your that you want to look at, and that can be handy. Trying to look at all stocks can be a little bit cumbersome there. Now, having said that, what I want to do is I want to talk about earnings for a sec and how that can affect your trades and your portfolio. One thing, let me make this a year chart. How about well, maybe not. Let's just look here. So this is just Amazon. I'm just, you can do this with a lot of stocks, and most stocks will probably look like this. Some will look a little different, but you have earnings on your chart, and this is implied volatility I have down here. And what happens is before earnings comes out, typically implied volatilities kind of generally go up, not on any given day necessarily, just kind of up and down, but in general they increase, and then earnings comes out and they decline. I think a lot of you have seen that. So it kind of goes through this cycle. It goes up, earnings comes out, they decline. What's happening? Implied volatilities are going up. At some point, we'll have earnings, and most likely we'll see a drop in implied volatility. Okay, so that's just an example. That's Amazon, and it's not just tech or communications or whatever or Amazon. Here's Nike. Kind of see the same thing here. Okay, drop on earth. So that implied volatility is likely to drop, and that's important because that can affect your option prices. Option prices go down. Everything else being equal, options prices go down when implied volatilities drop. Now, let's say you have a long call and implied volatilities drop and the stock goes way up. Does that mean your long call is going to lose money? No, not necessarily, because the stock, the movement of the stock may push that option up. But in terms of implied volatilities, and just looking at that alone, it can affect your trade. On your trades that you're looking at, the effects of implied volatility may not be the biggest factor that affects the trade, but those little things can make the difference. Okay, so that's what we're talking about today, those little things that make the difference. Now, what I'm going to do here is I want to look at an example of a trade and just kind of explore this a little bit and consider a trade with a little bit of a twist, different rules than we may use, just because particularly we have earnings coming out on some companies. Okay, so let's go and let me just go back to that market watch and see what we have coming out. Okay, so we have Netflix coming out on the 20th, which I think is Tuesday of next week. I think that's next Tuesday. Okay, so we have Netflix coming out, and Netflix has been doing terribly. I think it's been going down in FLX. This is what it's doing. I don't know what it's going to do in the future, but that's what it's been doing. But I'm not talking about a longer term trade. I'm not talking about a trend trade here. I'm talking about just looking at earnings, just a few day trade, because we said next Tuesday they're coming out, but between now and then, really we have Thursday, Friday, Monday, just 3 days of 3 trading days before then. So I'm just going to kind of look at the earnings with the expectation that this implied volatility, which is quite high right now, is likely to drop. Okay, it's likely to drop there, and so that's we're going to try and take advantage of that, the drop in implied volatility. Now, I'm going to do a trade that many of you are familiar with called an Iron Condor. Okay, an Iron Condor. And that is more of a neutral trade. Now, you may be going, why would you do a neutral trade right before earnings? Because the stock, as you know, can move quite a bit on earnings. Sometimes it moves quite a bit. It moved a lot on earnings there. Here, not so much. It didn't move as much on that earnings there. You would do an Iron Condor if, number one, you think implied volatilities are going to drop a lot, and number two, the stock is likely to move less than, say, the market expectation is on earnings. Okay, so what's the market expectation on earnings? Well, we can go to the trade tab, pull up Netflix, and I'm just going to go out to next week's. Look, we have one that expires in 2 days, but that's before earnings. Look over here. Next week, we have a 70% implied volatility. It's quite likely that implied volatility is going to drop down to something that's more akin to these implied volatilities after earnings. Now, this is an average implied volatility for the month, but you can see the average implied volatility for January 23rd is about 70%. If you go out in time, it's kind of 40s. That's a significant drop. That's like a 25-point drop there in implied volatility. Now, it may not drop that amount instantly, but very likely as soon as earnings comes out and it starts trading, you're going to see a significant drop at least. Maybe not the 25-point drop, but you're likely to see a significant drop in earnings. Now, the expectation is roughly, that's what this little plus minus sign here is. I'm going to round up the 7.8 to 8, roughly a plus or minus $8 move on Netflix between now and this would be next Friday. So this incorporates not just earnings, but a few days after earnings as well. An 8-point move, well, let's take that. Let's take the current stock price, which is about, we'll say about 88. If I add $8 to that, that's about $96. Or if I subtract $8 from that, that's roughly $80. Okay. So this is kind of the range that we're talking about here, between $80 and $96. And if we're willing to speculate, and that's what this is, it's a speculation, that Netflix is going to stay kind of within that range, we may consider doing this trade. In this case, it's an Iron Condor. So that's the first thing I'm going to do. So let's do that. So, and so Harry said, why aren't we doing double diagonals here? There's multiple trades that you can do that would fit the bill in terms of more of a neutralish trade. But remember this, when we do an Iron Condor is a negative Vega trade. What do I mean by that? I mean, it benefits if implied volatilities drop. That's our expectation, implied volatilities drop. If you think of calendars or diagonals, those are actually positive Vega trades. Okay, those are actually positive Vega trades. Now, there's special cases where you can do them on a calendar or a diagonal on earnings and try to take advantage of that. But I'm trying to break it down to more of the basics today there, Harry. That's why there's always different choices we can make on this. But we're going with the negative Vega trade here on this to try and illustrate our point here. So I'm going to do here. Now, we said 96 and 80 is kind of the range we're looking at here on this. So let me just do that. I'm going to just kind of draw in here on their chart at about 96. Okay, it won't be exact. We'll call it close enough there. Okay, and 80, it's right at the bottom of our chart. Okay, right about there. Okay, so that's the range we're expecting or hoping that Netflix is going to stay in on this trade. I'm going to go to let's go to the Analyze tab. And let's go to the Trade tab and just show you from there. I'm going to go out 9 days. I'm going past earnings, the first one past earnings. Now, this is a trade, this Iron Condor trade we're doing, I'm only going out 9 days. Do you know, when I normally teach people doing Iron Condors, aside from the whole earnings situation, this is kind of a special situation. Normally, we're going out closer to a month of that till expiration. Well, this is obviously not a month here. This is just a little bit over a week. And so there you go. So this is kind of a special use case, so to speak, on this. So we're not going out as far. Now, what I'm going to do is I'm going to use delta as kind of a guide here to try and help us find a strike. Now, delta, it tells us how much the option is going to move in relationship to a $1 move in the stock. It's an estimation, at least. It's not an exact. We don't know exact. But it can also give us an idea of kind of probabilities and help us to pick a strike price. And what I'm going to do here is I'm going to go to about a 20 delta, okay, for my short strikes. I'm going to go to about a 20 delta for my short strikes here. So on my puts, I'm going to go down and we'll pick, I'll go to the 81 perhaps, 81, that's closest to the 20. So I'm going to look to sell that. And I'm just going to go $1 out. I could go a couple dollars wide if I wanted to, but I'm going to just go $1 wide. I'm going to hold down my control key and buy that put. So I'm selling an 81 put, roughly 20-ish delta. I'm buying the next strike down, in this case, at least, and that's the 80 put. When I clicked on that, I held down my control key so that I didn't overwrite the first one. I want them both there. I'm going to do the same thing on the call side. I'm going to go to about a 20 delta. Well, we have one right on the nose. Now, you're not always going to find them exact. We'll just kind of in that area. I'm going to sell that one. I'm going to hold down my control key. And I'm going to do one more thing. I'm going to go to the next strike down. Oh, okay. Actually, I'm not going to go to the next strike down because the next strike is 50 cents. I'm going to go the $1 width here on this. And I'm going to hold down my control key and I'm going to buy that. Okay. Now, I went a little quick there, but notice there's a $1 gap between my strike prices on my put side, and there's a $1 gap between my strike prices on my call side. Okay. Even though these two technically were 2 strikes apart because the interval changed between, the distance changed between the strikes there. All right. There's a survey link in the chat, by the way. We appreciate your feedback on this. And if you have questions on this trade, let me know. Because what I'm going to do here is I'm now going to right-click on this. Try that again. I'm going to analyze the trade. And I want to look at this trade here on, we're going to look at this trade here on this. Now, there's some things I want you to look at and consider. Let's see, that's today's date. Let me just go to expiration, which we said was January 23rd. So when we're putting this date up here, I'm going to go to expiration day +1 to make sure we incorporate all that date in there. And I'm going to set my slices on this. I'm going to click on this little 3-line menu, set slices to our break-even points. Okay. There we go. And now what we can do is we can look at this trade. We can see it graphed out. For those of you who are not familiar with this graph, this represents potential profits, there's $100, or losses, there's a losing $100. Here's our break-even point, okay? Here's our break-even point. And John Forster, great question. I'll address that in just a sec, because it's not a right or wrong thing. There's our break-even point on this. And we want this blue line is the one we're looking at to be above the break-even point. That would indicate we're profitable on this. Now, here's our break-evens right here. Well, about 80.5 and about, we'll say 98. Well, we said that's kind of in the range that we said that we want Netflix to stay between. So it makes sense what we're talking about here. Now notice, there's pros and cons to this trade. One of the pros is this, it's a high probability trade. According to these calculations, and that's all they are, calculations, it's no guarantee, there's about a 76% chance that we're break even or better on this trade. Okay, that's good, high probability. Who doesn't like high probability? But there's a downside. Notice the break-even point and the distance between our max gain of that break-even point and where that is versus the distance between the break-even point and our max loss. There's a bigger difference there, right? In other words, we stand to lose more if things go south on us than we potentially gain if things go well for us. Fair enough. That's the price you pay for these higher probability trades. Reward to risk is not as good. Probability is pretty good there in that case. Are you willing to take that? I don't know whether that's up to you on this. Now, for one, John said, and I appreciate John for saying this because this is what probably a bunch of you are thinking. John said, I'm stressed that this may be a little bit tight, that the wings maybe should be wider. Well, we can make wider wings. What's the consequence going to be if we make the wings wider? Let's say we put wings out here, okay, strike out here, strike out here, because this right here is our short strike. Okay? This is our long strike. This is our short call. This is our long call. Can we move them out wider? We can move them out wider. That would increase our probabilities, but this would look a lot worse. It would look more like, actually, it would look more like this, okay? And forgive my unsteady hand as I draw this, okay? It would look more like that. With bigger risk, okay, lower reward, but higher probability. The 76% would go up higher. So, which is it? Harry said in the chat, do it paper money, do it both ways. Test, absolutely. I agree. So test them out on paper money and see what you like. It's not, as with any option trade we do in this webcast, either today or any other webcast, it's not necessarily a right or wrong thing, but it's just, trade-offs, I guess, in that regard. Okay, now, this is kind of neutral. The stock right now, let me get rid of this. What do we say? The stock's at 88 and change. If I want to make this more bearish, I could just shift my strikes down, shift my puts down, shift my calls down, and that would just shift this whole graph just off to the left, okay? Or vice versa if you want to make it more bullish. You could do the same thing. I'm not going to do that right now just for time's sake, and I want to make sure we don't shortchange our trade management today there. Now, here's one other thing I want to show you on this, because I want to talk about implied volatility. Let me just add a slice here to our current slice here. Okay, our Vega, okay? Here's our Vega, about 68 cents, okay? Not a lot, okay? The current credit on this trade is about $34. That's the most we can make, by the way. How do I know it's $34? Because I'm looking right here. I'm putting my cursor right here. I'm looking at the bottom left portion of this graph, right over here. I'm going to move my cursor for a sec. I'm going to look at that blue line in the bottom left corner of the graph. $34. Well, the most you can make on an Iron Condor is the amount of the credit. Okay? So that's that. So you can go, well, that's $34 isn't much. That's fine. You can always, if you want, you can always increase your number of contracts. If you increase the number of contracts, you're going to increase the premium. You're also going to increase the risk. Okay. You would just, if we do 4 contracts, 4 times the premium, 4 times the risk. There's also another consequence, especially when we talk about these option trades that have multiple legs, like 4-leg contracts like this, right? This has 4 different legs on it. We're also increasing our trading transaction fees on that, okay? There's more contract fees on that. So something to consider on that. But let's say we had a 10-point drop in implied volatilities. What does that Vega mean? Vega, where were we on Vega? Here we are, okay. What that would mean is, I'm just gonna round that 68 to 70. That would mean it's about 70 cents times 10 points, okay? 10-point move is what I'm saying, which is, I think, a relatively conservative estimation. That's about $7 overall difference in the trade. And you're saying, well, $7 isn't much, Brent. I agree, $7 isn't much, but consider it this way. $7 is 20% of our max gain. Now, of course, I'm not going to factor in doing multiple contracts here because we would just multiply this as well. This is roughly 20% of the gain, of the potential gain. This can make a big difference in the trade. Is it, if Netflix has gangbuster earnings and it goes way up, is that going to really make that big a difference? Probably not. But on those borderline cases, it can make a difference. And if things are going well, hey, it's a little bit better. If things are going poorly, it's a little bit less bad probably than it otherwise would be. Now, that's assuming we get that implied volatility drop that we typically see on that, but there's no guarantee on that trade. Okay, so that's the trade right there. I just wanted to kind of illustrate those things and have you keep in mind these. And I'm going to do a few contracts of this. Keep in mind implied volatility, how it affects things, and keep in mind earnings season's here as of a couple days ago. So here we go. I'm going to confirm and send this trade. I'm going to put this in our short verticals Iron Condors bucket, and it's thinking, but we'll let that sit here. Okay. Now, speaking of earnings, we did some trades specifically for earnings. We did a couple callers here for earnings. One of them was Bank of New York Mellon. I had a stock trade on there, 100 shares of stock. Going into earnings, we are a little bit worried on this. Well, let's just see what happened on this. Let me go to Bank of New York Mellon. You can see that implied volatility dropping, by the way, over there. What did it do? It went up. In hindsight, do I wish I didn't do? Yeah, I wish I didn't do the collar in hindsight because the stock reacted very favorably. But having said that, this certainly would have protected us more if the stock went down, but it cost us. Okay, it cost us about 220 bucks there on this. Okay, you can see our PL open on those. But the only reason I put this collar on was to protect us on earnings. Therefore, I'm going to exit it. I'm going to highlight those. Earnings is passed. The collar, my assumption here, and if you have a different assumption, you may just get out of the whole thing perhaps. My assumption is this trend is going to continue up. Okay, I can do moving averages to help me, do my technical analysis. We have higher highs, higher lows, trend is up. We're past earnings. I'm going to assume this is going to continue up. So the reason we put on the collar was to protect us. That reason is now gone. Therefore, we're going to get out of this trade. I'm going to buy it back, put this in, confirm and send. I'm going to send this order. And now my Bank of New York Mellon is unencumbered. If it goes up, we'll take advantage of it. If it goes down, we'll probably say we wished we would have left that collar on, but that's not. We're in the markets because we think we're in this trade because we think it's going to go up. We had a similar thing on Delta. Okay, Delta Airlines. Let's see what Delta did with earnings. Okay, DAL. There's Delta. Delta dropped on earnings. So the collar probably helped us in this case. But again, we're past earnings. That was the reason it was there. And you can see Delta helped us to the extent of roughly $120. Not huge, but I wanted to protect it in case it was just a terrible, terrible earnings. And so now, look, this expires in 2 days. Anyways, this is in the money. And I don't want to get assigned with all this stuff. I want to keep my Delta Airlines stock, and I'm going to highlight both of these. I'm going to right click on this. I'm going to create a closing order. We're going to get out of this trade because the reason we put in this trade in the first place was to protect us on earnings. Earnings is passed, and so we put the trade in there. It hasn't filled yet, but we'll, if it doesn't fill, I may tweak it. Okay. Actually, I may tweak it later, but let me do this. If you ever do this, you do a trade, it didn't fill. I thought it was going to fill. You can always go up here to your working orders, right click on it, cancel and replace that order. And you can see, look, it's not filling at that price. I'm going to move that price up. I may have to go more towards that natural price, see if it'll fill. And if that doesn't fill, what we may do is we may go, there's something kind of screwy on this. This is not filling. I'm actually going to cancel this order. Okay, we've canceled that order. and I'm going to do them one at a time. So in other words, I'm going to go here. I'm just going to look to exit this exit this put. I'm going to create a closing order. We're going to get out of the put, and well, actually, we'll just leave it at the natural price. I'm going to confirm and send. We're out of the put now, and I think we can see why this call option wasn't filling, why the whole trade wasn't filling, because it's basically worth nothing right now. It's almost worth nothing. So I'm just going to leave this as a covered call right now with the $76 strike. We're past earnings. This will should, assuming it stays out of the money, should expire worthless. Theoretically, it could be assigned. I welcome it if it were to be assigned, because that would mean somebody would be buying our Delta stock for $76, even though the current price is about $68. Okay, so we'll let that sit. Okay, so that's all I wanted to show on those trades. Let's look at some others. Let's go to a long option that we have been looking at for months now. And we've been saying, hey, when this gets to a high enough delta, we're going to get out. We're going to roll it. We're going to roll it. Well, sure enough, our delta is now about 85.5 there. Okay, so that's great. That means things have been doing well. When we initially did this trade, look, we initially did this trade way back when. It was like a 60 delta. The delta went up to about 85, I think. We rolled it, took profits, took like $3,000 in or something like that on this paper trade, and we rolled it back down to 60 delta. It is now up to an 85 delta again. I'm going to roll it back down to a 60 delta. Now, there's pros and cons about rolling it, okay? There's pros and cons about rolling it out. Let's talk about the pros to start, and then we'll do the cons, okay? The pros are, I bring in a credit. I'm going to bring in a credit here, okay? That's a nice thing, and we'll see that in just a minute, okay? The other thing is, I'm reducing the delta so that if it does go against us, it's going to go against us at a slower rate. Here's what I mean. Every dollar move in the underlying stock means about an $85 move in this option, okay? So if the stock starts to go down, instead of losing $85 per dollar it goes down, we're only going to be losing about, if we roll to 60 delta, we'll see, about $60. So it can help, I don't know, protect us. I don't know if that's the right word, but it helps lessen the negative impacts of the trade. Now, you can probably see where this is going. What's the negative side of this? The negative side of this is if Caterpillar keeps going up, well, I'm partaking of less of the gains by rolling this down to a 60 delta. Okay, I'm only making $60 per dollar move as it goes up. Now, I guess before we roll, we should ensure that we're still bullish on this trade, and for that, we'll use our technical analysis. Now, remember, technical analysis is not the sole means of investment research, but we're going to call this a nice trend up. We're going to call that a bullish trend here for our purposes. So I'm going to look to roll this out. I'm going to go, it's 366 days till expiration. This is a Leaps call. I'm going to go to the trade tab. I'm on Caterpillar. Let's find that trade here. Okay, let's scroll down. There it is. You can see that right here. And I've got a trade. Now, I also have a stop order on this. What I'm going to do here is I'm going to cancel the stop order because I'm going to change the strike. It doesn't do me any good, by the way, to have a stop on a 450 call if we don't have the 450 call anymore. So I'm going to cancel that order. I'm going to look to stay in this because we're still a year out till expiration on this thing. So no need to roll out, but I'm going to look to roll this down from the 86 delta to something closer to the 60 to 65 delta. We'll go to the 61 delta here, okay, to the 620 strike. Now, can you see where the credit's going to come? We're going to be able to sell this for about $20,000. This is an expensive trade, right? We're going to sell this for $20,000 or that. That's not what we're doing here. Okay. I'm going to make these the same expiration date, January 15, 27, and it's going to give me a little message here. And it says diagonal may not have identical. You're right. I'm not. I'm going to change these. And we're going to change the one to the, my gosh, how did I already forget this? To the 620 strike. Okay. We're going to change this to the 620 strike. Buy out of the money, that 620 strike. There's our credit right there on that. And the mid price, we may not get exactly the mid price, but we're going to confirm and send. Remember, rolling doesn't save us the commissions, but we're going to do this and we're going to send, and there we go. Okay. All right. And here we go. So we just rolled this trade and that's gone. This is our new trade. We have our 620 call. Now, do you guys have any questions on what we just did? I know we had a little tech issue there for a sec. Is there anything? I think I showed you what we did, why we decided to roll, and the exact process of rolling. If you missed any of those things, let me know and I will go back over those because I don't know exactly what you missed, but I think I was aware of what we missed there. So I think I went through those three things. Just use the chat. Let me know. Okay. Now we're almost out of time, but I'm going to do a similar thing here. And we're going to go out of this long single options. And I'm going to go to this category here because there's another one that maybe we want to consider. Well, let's look at CMG. We have a diagonal spread here on CMG. Okay. Let's look at what this is. This is that. Okay. All right. So I'm getting some comments in the chat that you didn't. I can't. Okay. I know I didn't get cut off for the whole thing. We rolled it because it was at an 85 delta. I think I went through the reasons. Okay. This was, I apologize for being cut off here. Caterpillar was doing very well. We got up to our 85 delta, which is kind of the rule we use. We rolled it down to a 60 delta. We did that to take in a credit primarily by selling the 450 and buying the 620. In other words, rolling to the higher strike, we brought in about a $10,000 credit into our account on that. Now we've reset that PL open here. We now have, this is a new trade. This is a brand new trade. We did this because we're still bullish on Caterpillar. We could have just sold out of the 450 and bought the 620 as two separate transactions, but we elected to roll it there. Okay. If anything I just said doesn't make sense, let me know. But I believe you caught most of that there. Okay. Let's finish up with our Chipotle trade. Chipotle is a diagonal spread. Different strikes, different expirations. Let's look at the chart here. Okay. Here is, that's not it. That's Caterpillar. CMG. Okay. Here's CMG. You can see this is a bullish trade. I only want to continue on with this trade if I'm still bullish on it. Am I still bullish on CMJ? I'm going to say yes, because our trend is going up. Okay. It's simple as that. We're above that 20-day moving average. It's been trending. We're going to assume that trend is going to continue, although it may not. But we have a problem. In 2 days, we have an expiration here on this contract. Now, there's a big difference between 37 days on the long contract and 2 days to expiration on the short contract. What I can do is, if I want to continue with the trade, is I can take this and I can roll this out to a date that's not all the way to this date, but maybe halfway between it. Maybe we'll look to the end of January, perhaps. And I'm going to look to go out of the money on that contract. Generally, we'll go out to about maybe a 30-ish delta, somewhere in there. Let's look at this. So let me go to CMG. This is our short contract, expires in 2 days. I'm going to go to January 30th, 16 days. That still gives us time between our new short contract, which will be here, and our existing long contract. We're not going to touch the long contract. We're just going to roll this short one out to this date. I'm going to look at my delta. I'm going to use the same thing I did before. I don't really have a 30 delta, but we got a 25 delta. And I'm going to roll to this 25 delta, which is 42. Remember, deltas tell us how much the option is going to move in relationship to a $1 move in the stock price, but it also gives us a probability. This is going to give me a probability of this short option being in the money of roughly 25%. So most likely, it's not going to be in the money. That's how we want to do it. So we're going to roll this to a 42 strike. I'm going to go through the same process I did before. 42 strike on the other contract we just rolled. I'm going to right click on it. I'm going to create a rolling order. In this case, I am changing the expiration date from January 16th to January 30th. Now, notice it didn't put in January 30th, it put in January 23rd. But it can't read my mind. It doesn't know what I want to roll it to, so it just goes to the next expiration. So in this case, I'm going to change that to January 30th. And we said the strike was going to be a 42 strike. So I'm going to go to that 42 strike. Hold on. Did I do that right? I think I got my strike wrong. No, that's right. 42 strike. Okay. Let's go here. All right. And we're rolling this trade right here. And we're going to confirm and send. And we're going to send this order. Okay. So we just rolled it. All right. So there we go. Now, Chris said it's a loser. Yeah, it was a loser if you just look at that one contract. But overall, this trade was actually doing quite well. Remember, anytime you look at an option trade, and I'm going to finish up with this, you're likely to have one winning leg and one losing leg. Not always, but usually you'll have one losing leg and one winning leg. And you're always going to have a winner, not always, but very often you'll have a winner. And you can't get too excited about the winner because you have this loser at the same time. Similarly, you can't be too depressed on when you see the loser because you have the winning leg at the same time. What we care about is the sum total of the trade, the total trade there. That's what we care about. Thank you all for joining me. Thank you, Connie, for helping me out in the chat. Everybody, wish you all a wonderful week ahead, and we will see you all same time next week. Bye-bye, everybody.